the ones who have been with us throughout this journey since June. Asanteni sana. Today we are going to be talking about investing for Chamas, whether you should invest in a Chama, how you rhyme your personal investment personalities to form one group, so that you can invest in a goal, like you have one aligned goal, whether you should actually do it, yeah, and if you're doing it, where you should invest. This is Vasili Africa. Once again, we have been doing training since June. We are an independent investment agent and a consultant. So you can talk to us about all your investment needs. We give you financial advice, see where you are at in life, and see the investment goal that you should, the investment vehicle that you should take, and how to diversify your investments. For the past trainings, they are on our YouTube channel. We have recorded them, they're on our YouTube channel. They can also be sent to you via links. So you can share your email addresses for those who are just joining us. Yes, and today we are joined by David Gitau, who is the investment manager for CIC Asset Management Group. That is more, for others, they call them portfolio managers. We choose to call him investment manager. He's a CFA. And a very good close friend of ours. So karibu sana, David. We shall take all the questions and then we shall answer them at the end of the training. So feel free to shoot your questions, type them in, and we are kindly requesting you to mute yourself as you get in. Asanteni sana. David?
Thank you very much, Rose, for giving me this opportunity to train Chamas. But before I begin, I'd like to just give a brief something about myself. I began my career as an investment analyst at a stockbroker, basically telling investors what to buy, what not to buy, what to avoid. But the concentration that time was on the stock market. Then I moved on to corporate finance, where we were just raising money for small and medium enterprises, either by debt or shareholder funds. Currently, I'm an investment manager at CIC Asset Management. Basically, managing investments, both institutions as well as individuals. Between me and my colleague, we're managing about 68 billion Kenya shillings worth of investments minus property. So guys, you're in safe hands. Huh? I'm also a CFA charter holder. Basically, the agenda for today will basically look at what investments are available for us. And we look at just basically 3 investment objectives. And then we can move into the substantive training on Chamas. So just to start off, investors usually have 3 objectives. And the first objective is capital preservation. Here, basically you're saying, Rose, there's somebody who's on unmute.
Yeah, kindly mute yourselves as you get in, tafadhali.
Yes, as I was saying, investors basically have 3 objectives. The first one is capital preservation. And basically with capital preservation, you're saying you don't want to lose a single coin. The shilling you put there, you should find it tomorrow. But what is even more important is that the shilling must at least grow at the rate of inflation, at the bare minimum. So if you're investing 100 shillings, or if you're buying unga at 100 shillings in January, and by December it's expected to go up by 110, that 100 shillings should have at least grown to 110 so that you can afford the unga then. Not leaving it idle such that at the end of the year you still have the 100 shillings and you're only able to buy 3/4 packet of unga. Anyway, the 3 investments that achieve this objective: 1 are bank deposits. Forget about Chase Bank and Imperial Bank. Those were just one-offs. That's not supposed to happen, because when you put money in the bank, you're supposed to come back and find it. But with bank deposits, the key thing here is you're lending money to the bank at an agreed rate at the beginning for a certain amount of period. So just to be on the same page. So if you agree with the bank that they're going to give you 12% per annum, that means you know you're earning 1% per month, and you can work further backwards and know how much you're earning per day. And the bank basically uses that money to lend to others. The second investment that achieves capital preservation are what we call treasury bills. Now, with treasury bills here, you're lending to the government, and just like bank deposits, which are 3 months, 6 months, or 12 months, treasury bills are also for the same duration. And at the beginning of the engagement with government, you agree on a rate. And the way treasury bills work is that, suppose you want to lend the government 100,000, and they've agreed to give you interest of 10,000. Oh, sorry, 10%. So you take the 10% of 100,000, which is 10,000, and then now you deduct 10,000 from 100,000, you get 90. So basically, what the government is telling you is, give me 90,000 today, and then I'll give you back 100,000 at the end of the period. So it's basically getting a guarantee where you give them less, and then you get more at the end. The third investment that achieves capital preservation are what you call commercial paper. And commercial paper works exactly like a treasury bill. The only thing here is that you're lending to corporates. For example, let's say you have a high-end vehicle seller who imports a Range Rover or something like that. But it takes him like 3 months to sell that Range Rover. In the meantime, he has to pay salaries, he has to pay rent. So that's how they come to the market to borrow for either 3 months, and typically 3 months or 6 months. And for treasury bills, basically the government uses that money for its short-term needs. These three investments collectively are known as the money markets. Notice that they're all short-term. They do not exceed 1 year, and all you earn is interest. So how do you go about investing in the money markets? One, you can go directly. Go to the bank and negotiate with the bank for a fixed deposit at a certain rate. Currently, you'll get about 4 to 4.2%. You can also go directly to central bank, open a CDS account. They usually ask for the same usual requirements: passport size photo, PIN number, bank statement. And you can start engaging with government. Government comes to borrow in the T-bill market every week. I don't expect any of you to go and buy commercial paper directly. One, because of maybe the amounts that are required, and secondly, you may not have the capacity to analyze these companies to know or to understand whether they'll be able to pay you back or not. And we've had several commercial paper failings in the past, so it would be a wise idea to go directly. Recently, we had Nakumat. Before, we had even Athriva Mining, and back in the day, Triton. The other way you can invest in the money markets is through what we call a collective investment scheme. Now, a collective investment scheme works on the same principles as a Chama, because as a Chama, you come together so that you have more money. With more money, you have better negotiating power, and you can also do bigger things that you would not ordinarily be able to do by yourself. So how is the structure of these collective investment schemes? Now, in Kenya, these collective investment schemes can take two shapes by law. Either it can be a company or stroke investment company, or it can be a trust. Now, most of the ones in Kenya, the collective investment schemes are formed as trusts. In fact, I think all of them. And this trust, just like a company is formed under the Companies Act, this trust is also formed under the Trust Act. And just like a company has the articles and memorandum of association, the same way with this trust has what we call a trust deed and an information memorandum. The trust deed is basically the katiba of the trust. It describes how the trust will be run. The information memorandum just describes how the money in this trust will be invested. Now, notice that this trust is a separate entity. So if I use CIC's collective investment scheme, which is called CIC Unit Trust Scheme, that trust is a separate legal entity. And this is where most people misunderstand these collective investment schemes. For example, they think they're putting money in CIC. No. What CIC has done, or what CIC Asset Management has done, is it has created this investment vehicle in the form of a trust. So people are actually putting money in this trust and not in CIC. And this, again, might come as a shock to many. In as much as CIC's trust has CIC's name, CIC is not the boss of that trust. The trust is actually run by the trustee. In our case, it is KCB. The trustee is the one who holds the assets of the trust in trust for all the people who are putting money in this trust. The other person who is important in this network is what we call the custodian. Now, the custodian basically is the one who is supposed to keep all the records of all the investments in the trust. And he's also supposed to keep all the documents of title to this trust. So if this trust was, let's say, a property trust, the custodian would be the one holding the title deed. All money is paid into the custodian, and it's the custodian who pays out all money in the form of withdrawals. Now, this is where the fund manager comes in. As a service provider to this trust, the fund manager is basically the one who gives investment directions. So he will tell the custodian where to take money, etc. The fund manager has also two other additional roles, not just giving investment directions. One is administration. For example, CIC's trust is now at about 40 billion. So the custodian is seeing 40 billion worth of investments and is keeping those records. But the fund manager is doing administration, that is meaning the day-to-day nitty-gritties of the trust. And so the fund manager, in terms of administration, is keeping the records of all the individual investors in the trust. Doing things like investing. If you want a withdrawal, it's the fund manager who instructs the custodian to pay. And because this is a separate entity, it has to keep financial records, and that is also done by the fund manager. Now, because the money in this trust belongs to the government or belongs to the public, government must be involved to protect the public. And in this case, the government is involved through Treasury, through the Capital Markets Authority. Just like the banks are regulated by Central Bank of Kenya, these collective investment schemes are regulated by CMA, the Capital Markets Authority. Now, because this trust is a separate entity and it has financial records, at the end of the year, the financial records must be audited. In our case, the auditor is PwC. And then you have your investor who puts in money into the trust. The fund manager decides how that money will be invested. The custodian keeps all the records, and the trustee oversees the trust. Every 3 months, the trustee will call a board meeting, what we call a board of trustees meeting. And the custodian and the fund manager have to go and report their day-to-day activities, in as much as the trustee is also seeing that on a day-to-day basis. Every 3 months, the trustee, custodian, and the fund manager have to send the reports to the regulator, CMA, and the regulator can come to your offices at any time. The regulator is the one who licenses the fund manager, the custodian, and the trustee. In as much as the trustee is KCB and the custodian is Co-op, and they're both banks regulated by Central Bank of Kenya, that department of trusteeship and custodialship in those banks is regulated by the Capital Markets Authority. So on average, money market can range from 9 to about 10% over the last 10 years, though interest rates have been progressively becoming down, and they're expected to come down even further. These are just some industry statistics as at the end of last year. Fresh statistics will be coming out, I think, next week or so. Then CIC was at 29 billion with a market share of 40%, the biggest fund manager in the collective investment schemes. Now we are at 40 billion. But those are just all the service providers who are licensed by Capital Markets Authority to run collective investment schemes. And there are quite a number of them. So in total, last year, the industry had about 74 billion in assets under management. Now, the risk profile, before I go there, now, the trust that invests in the money markets, that means bank deposits, commercial paper and treasury bills, is what we know as the money market fund. In terms of the risk profile for these funds or for capital preservation, the risk is low, so you also don't expect much. You'll just get a low return, and I've just described to you the returns are usually about 9 to 10% on average over the last 10 years. How can you use this collective investment scheme like the money market fund? One, if you, as a Chama, if you're saving for a project, it's an excellent place to put your money instead of leaving it idle in the bank. You can see the difference in returns. If you go to the bank, you get about 4%, but if you go to a money market fund, you get about 9 to 10%. As individuals, it's a very good place to park your emergency fund. This has become a very important thing right now because of what is happening with the COVID-19 pandemic, where people didn't have a fallback mechanism, and now they're seeing the importance of having an emergency fund. In terms of an emergency fund, the default number is 6 months of expenses. But basically, if you're employed, the key question to ask yourself is, how long will it take me to get a similar paying job? If it's going to take you 3 months, then put 3 months in an emergency fund. If it's going to take you 8 months, then have 8 months expenses in an emergency fund. Education will never be and has never been an emergency. You can actually plan to pay fees by funding the money market fund with a requisite principal, and then you just pay fees every 4 months from the interest that you earn on that investment. If you have idle cash which you don't know what to do with or which you're planning to use in the future, you can park it in a money market fund and earn some interest. The key thing is to make your money work for you. You work very hard for your money. Money must also return the favor and work for you. Like I said, if you're saving for a project, e.g., maybe you're saving to buy land later on, perfect place to put it is in the money market fund. You want to save for holidays as an individual, perfect place. Basically, a money market fund should be your default savings account. So what are the advantages of going into a collective investment scheme as opposed to going directly? One, you have higher returns because remember, there's more money in these funds, so they have better negotiating power even with the banks. Currently, like I said, banks are giving you about 4%, but money market funds are ranging between 9 and 10%. The other thing is liquidity. When you want your money, you can always withdraw from a money market fund. If you go to the bank, your money is locked for the period that you had agreed, whether it is 3 months, 6 months, or 12 months. If you want to withdraw before that, there usually be a penalty. Worse still, if you bought a treasury bill, let's say for 1 year, a 1 year treasury bill, you are stuck for that duration of the period. In fact, treasury bills is even worse because if you want your money back, it will come back. The penalty is 3%, so it will come back 3% less. And thirdly, money market funds, basically you can access them with small amounts of money. With treasury, if you want to buy a treasury bill, you need at least 100,000, but you have money market funds which are doing it 1,000, 5,000 as entry, and then we're benefit of being in a collective investment scheme. Now, the second investor objective is growth. Now we're moving into more interesting themes. The second investor objective is growth. Basically, with growth, you're saying you want to double, triple. There, the keyword there is over time. and not overnight. And the two investments that achieve the objective of growth are one, a property, and the other is shares. So in terms of property, how do you double or how do you triple your money over time? There are two ways that you can go about this. One, you buy a piece of land, you add value to that piece of land, and then you sell. By adding value, I mean either you improve the infrastructure or you put up a building with the intention of selling. The second way you can get good returns with property is you buy a piece of land and you subdivide it. In Kenya, when you subdivide land, on average, you get returns of 30, 40% on top. So as an investor, you are not supposed to buy eighths. You are the one who is supposed to be selling the eighths. All those stories of brought maguta, you will not make money. The person who makes money is the guy who is subdividing and selling to you that eighth. And you can also do both. For example, people like Tattoo City, they add value and then they cut up the plots. When they add value, they build something, they build the roads. So them, they're bigger players, they do both. As individuals, we're more likely to do the second bit, where you buy a large plot and then you subdivide it. So what is my recommended strategy? One, always buy property where the fundamentals are in place, or if they're not in place, they are coming with certainty. Yes, one may argue that these pieces of land will have a higher price. That is very true, but the returns come earlier and they are more guaranteed. And when I say fundamentals, I mean the roads, the road network, electricity, sewerage. So you're not looking to go and buy land very far. Like you get good deals that you go and buy land in Namanga somewhere. The returns on that land will come after 20, 30 years. Here you're looking to get returns in 2 years, 3 years, and you exit and you've doubled your money. Secondly, money is not made at the end, money is made at the beginning. So you're not looking to buy the land at the market price. You're looking to get a discount. And where best to get these discounts? You get them from people who are what we call motivated sellers. Somebody who is in a financial crisis and needs cash very fast, and you are there to help him out with cash. So he is willing to give you a discount. So if you get a discount of even 20%, and then you are not in a hurry, and then you go back to the market, you've already made like 20% on top of that. If you now subdivide, you'll make another 30%. So you see how you're making now money. That is like 50% return. So always buy from motivated sellers. Where do we get information from motivated sellers? If you look at the Monday Nation, you'll always see the auctioneers page. Those are motivated sellers, people who have been unable to fulfill their financial obligations, and now their property is being auctioned. Also talk to agents and that kind of thing. The other thing is always do your research. My recommended strategy is to pick 2 areas, what we call the frontier areas, where people are expected to go in the near future. Just pick 2 areas, understand the dynamics of those areas, so that when you get a deal, the only question you're asking is, what is the motivation of this person to sell? Because you already know how land prices move. So basically, you're either doing that through the internet, going on the ground, every so often understanding what is happening in the area. Now, a friend of mine some time back got a deal in a place called Katani. Katani is one of the frontier areas right now with high potential for growth. The infrastructure where he was looking at this piece of land was actually quite terrible, because they were now just building the roads, so the road networks were bad, electricity is on site. So he gets a deal to buy an acre at 4 million. Now he has the 4 million shillings. The question now he was asking me is whether he should use the entire 4 million in cash, or should he just use some and then borrow the rest. So he decides. So what basically we were doing is we were trying to calculate in the future, in 2 years' time, how much he would make. So we decide that he's going to invest 1 million and borrow 3.3. 300,000 goes to the bank as admin charges. So he has now 4 million. So on your screen, you have the loan amount of 3.3 million. The interest rate then was 14%. Now it's gone down to about 13%. The property buying price was 4 million. We made an estimate that this piece of property will appreciate by about 15% per annum. Now we were estimating that the road would reach near his plot in 2 years. So in 2 years, he wants to exit in 2 years. Now, then the current price of an eighth was ranging between 800,000 to 1 million in the same area. So you can see if he was to subdivide immediately into 7 pieces, 800,000 times 7, because when you subdivide, let's say an acre, you get 7 eighths. 1/8 goes to the roads, the road infrastructure. So you can see 800,000 times 7, that's already 5.1. He has bought the plot for 4 million. So he's already in the money. Remember, you're buying from a motivated seller. So after 2 years, what happens? He subdivides, gets 7 plots. Now, each plot now has increased in value first year by 15% and the second year by 15%. So now each plot is worth about 1.3 million. So if he was to sell all 7 of them after subdividing, he would get approximately 9.3 million in cash. Now, remember, he had borrowed. So he still he had taken a 5-year loan, but he knows he wants to exit after 2 years. So just remember that he borrowed, started paying back immediately. So there are payments that he had made to the bank of about 1.8 million. The principal that was remaining to be paid to the bank, the balance was about 2.3 million, and the down payment he had made was 1 million. So he had basically spent about 5.1 million, and then miscellaneous expenses, surveyor, advocate was coming to about 300,000. So in total, he had spent 5.4 million. So when you're calculating the profit, we take the future price of what he would get minus the 5.4, and the return is about the return was about 3.8 million in terms of profit. The return over the 2 years was 70%. You divide that by 2, you get about 35% return. Now you can see how we are doubling and tripling our money. You can compare that to the money market fund, which returns about 9%, and here you're doing property of about 35% per annum. So the next scenario was without debt. What happens? So he sells the plots, gets 9.3 million, but this time he had paid cash of 4 million, miscellaneous, advocate, etc. comes to about 4.3 million. And he had a profit of approximately 5 million, with a total return of 115% over the 2-year period. So each year the return was about 57%. So basically, in a nutshell, this is what happened. And maybe by a show of hands or in the chat box, which is a better deal? This is not a trick question. Which is a better deal? The one that returns 35% per annum or 57% per annum? Rose, can you see the chat box?
Yes.
What are the responses there?
See. Without debt, of course. From Wandia, from Irene, without debt. Yeah. Anyone else?
No, it's okay.
57%, 35%.
Okay. Now, those guys who are saying without debt is a better deal, you are all wrong. This is how to look at it. Suppose, remember the first scenario was he put in 1 million of his own. Suppose he is able to get 3 extra plots, 4 plots, and he's able to borrow and do the same strategy, he can increase his return from 3.8 million to 15.2 million. So the other way to look at it is that he puts in 1 million, he comes out with 3.8 million. So that's like a net profit of about 2.8 million. On the other hand, he puts in the entire 4 million, comes out with 5 million. So it's like he has made 1 million. So he's using money more efficiently over here. So what that does, it magnifies your profits or your returns. But when things go wrong, it will magnify your losses by the same amount. But remember, you're buying these pieces of land in places where the fundamentals are in place, where your returns are more guaranteed and they come faster. So the second investment that achieves the objective of growth is basically shares. And shares can either be public, the ones that are traded on the stock exchange, or it can just be in the form of a private company, either your own, or you're investing in basically investing in a private company. We all know that the richest people in this country are entrepreneurs, and basically they operate in the private space. And when you're buying shares in the public, there's no difference between buying clothes and buying shares, or even buying vegetables. The stock market works exactly like any other market, whether it is Marikiti or Gikomba. Gikomba, the product is clothes. Marikiti, vegetables. The stock market is basically shares, which means when you buy a share of a company, you become an owner in that company, and then you share in the profits of the company in the form of dividends, but you also share in the losses. And basically, when you're buying shares, it's just like buying clothes. When you're going to buy clothes, you're looking for quality clothes that are selling at a good price. So you look at quality and price. The same thing with shares. You're going to buy shares in a company, which is a quality company, basically one that is already making, one that has good management and a good board, one that is already making money, one that has a product or service that is relevant, and fourthly, one that has a very huge market for that product. That is the quality bit. In terms of price, what happens in the stock market, sometimes what is happening in the company is not what is happening in the market. A company could be doing very well, but the share price does not reflect how the company is doing. And the people who can guide you with this are the stockbroker, the guys who are called investment analysts. They sit in what we call the research department. They're the guys who can tell you that this share is trading at a discount to its true value. So as an example of how you can make money, I'll use Safaricom as an example. Safaricom came to the market at 5 shillings. A few days ago, it was at 30. So we'll just use 30 as an example. So the way you calculate return is you take the ending price, which is 30, you minus the beginning price, which is 25. So the answer there is 25. You divide that by the beginning price. So basically 25 divided by 5. And then you multiply it by 100 to make it into a percent. So 25 divided by 5 is 5. 5 times 100 is 500%. So basically, since Safaricom came to the market, it has returned an average of 500% over the 10 years. If you divide that by 10, it becomes an average of about 50% per year. But of course, that was not a straight line. There were times it went up, down, up, down, up, down. But in the stock market, you're looking at being there, being invested for the long term, and that's how you can actually reap. When share prices are going down like they have in the recent past due to COVID-19, you just hang in there and think long term. You never panic when prices are coming down. The risk profile for shares and for property, of course, is higher risk. So the potential for return is also higher. So investing in shares, you can either go direct, go to the stockbroker, open a CDSC account, and again, get in touch with guys in the research department who can guide you on what shares to buy. You can also go into a collective investment scheme, what we know as equity funds. Equity funds basically invest the majority of the money in shares at the stock exchange. Now, back to the third investment objective, which is income. Income, you're looking for a steady stream of income, which is readily predictable. But again, you're looking over a longer period of time. And the two investments that achieve the objective of income are one, bonds, and the second one is rental property. Now with bonds, how treasury bonds work or corporate bonds work is if government is giving you interest of 10% per annum, and then you're lending to them at 100,000, so that is 10,000 shillings in terms of interest. So what happens is in the year they're going to give you 10,000 shillings, but what happens is every 6 months they give you 5,000, and then after 6 months 5,000. So if you're lending, let's say, to government for 2 years, you give them 100,000 at 10%, you get 5,000 interest, 5,000 interest at the end of year 1, 5,000 interest in year 2, and then finally your last interest of 5,000, and then they give you back your 100,000. So the difference between a treasury bill and a treasury bond, a treasury bill you're giving them less, but in terms of a treasury bond you're giving them the entire amount. Again, when it comes to rentals, the best value or the best returns are found in multi-story dwelling units, not in purchasing bungalows or apartments. The best use of space is upwards. Now for bonds, you get interest or coupon every 6 months. Of course, for rentals, you get rents on a monthly basis. And the best way to analyze whether rental income makes sense is to use what we call the rental yield. And the way it's calculated is calculated as the annual rental income, so monthly rent times 12, divided by the price or the cost of that piece of property. And then you multiply by 100 to get a percent. On average, good rental yields are between 11 and 12%. The risk profile for income is basically medium, and the returns are also just moderate. So investing for income, of course, you can do that directly. Go to CBK, again, use the same CDS account to buy bonds. Central Bank basically borrows from the market once a month. You can also go into a collective investment scheme, what we know as bond funds or fixed income funds, or you can also go to the stock market and buy units in what we call an IREIT. IREIT means a REIT is a real estate investment trust. It works on the same principles as a collective investment scheme. In this case, I stands for income, so income rate. Now these REITs, they trade on the stock exchange. So as a Chama or as an individual, how do you proceed from here? One, you need to understand your current position. Basically, what we're saying is your income and your expenses. So as an individual or even as a Chama, put how much income is coming in. And then you also jot down how your expenses are also affecting you. So basically, especially as an individual, come up with your budget, income versus expenses. Whatever answer you get from that, if you divide that by your income, multiply by 100, you'll get what you call your savings rate. Always try and achieve a high savings rate as much as possible. And the theme here is this: every time you spend money, you're making somebody else rich. If you invest that money, you're making yourself rich. The other thing about understanding your current position, understand your assets. So jot down your assets, whether it's land, money market funds, cash maybe in the circle, minus your liabilities, and basically what you have there is what you call your net worth. So whether you're a Chama or an individual, have this down. That net worth figure is the most important figure in your life. It is the one that determines whether you're wealthy or not. And that net worth figure goes up basically if your savings rate is very high, plus also based on the returns that you get from your investments. So again, I need to reiterate, your net worth is your most important figure, and save as much money as possible because you're trying not to spend today so that you can have a better future tomorrow. So as a Chama, what do? You need to develop a plan. You need, as a Chama, to define your objective or the objective of the group very precisely. Most Chamas break up because people are pulling in different directions. One thinks they're investing, another one thinks it's for welfare. Have your objective defined very precisely. Secondly, what you need to do is to develop what we call an investment policy statement. Okay, you may not have, of course, the capacity to do this, but a financial advisor can help you do this. Typically, this investment policy statement, or IPS, is the blueprint of how the money will be invested, so that you don't have quarrels within the group. It tells you we are going to put 20% of our money in shares, 40% in stocks, 20% in money markets, so that you follow that objective, so that you follow that investment policy to the letter. And then every so often, like every 3 years, you relook at it and see whether it is still relevant. So every month, as you have your meetings, you're basically reviewing, are we moving in the same direction as this investment policy statement? Because this investment policy statement dictates basically, based on your objective, where you should invest the money. But the key important thing is also have an action plan to implement. Because you have an objective and you have an investment policy statement, so you must have a discussion in your head or amongst the group. How are we going to implement this plan? If we want to reach a certain goal, but we're only investing 5,000 and now we won't be able to reach that goal, what do we need to get to our goal? Do we need to increase our money? Do we need to increase our savings or not? So the key thing there is to define your group, the objective of the group, and to have an investment policy statement, and therefore to take action. Basically, what the investment policy statement states is it states basically the willingness to take risk of the group members collectively, but this is just a function of the brain. What is more important is the ability of the group to take risk. And again, here it just depends on how much money you have saved. The wealthier the group is, of course, the higher the ability to take risk is. It also defines your risk tolerance. So the willingness to take risk and your ability to take risk, when combined, defines how much risk you can actually take. Then thereafter, it looks at your desired return. What kind of return are you trying to get? Again, this is a function of the mind. And basically, your minimum return. It defines what is the minimum return that we should get per annum for this group. And usually that is based on inflation. And then after that, you find out what the return requirement would be. The other thing it also looks at is the constraints that the group may have in terms of how often are you removing money from the investment. Initially, when you're younger, no money is really coming out. It's just going into investments. But as you get older, you find now, after retirement, and you're still a group, money starts now to leave the Chama. It also looks at the time horizon. What kind of time horizon are you looking to invest for? Is it 10 years, 20 years, 30 years? Again, it also looks at the tax position of the Chama, but in most cases, Chamas are taxable. It looks at any other legal issues that the group may have. and not issues per se, is whether the group, how is the group formed? Is it a company? Is it a partnership? Is it just joint ownership? I mean, again, it looks at any unique circumstances that the group may have. You may have individuals in the group who are maybe very religious, so they may not want to invest in shares of East Africa breweries, that kind of thing. Now, as an individual, what are the key things to also look out for, as opposed to being a Chama? As an individual, you set out your life goals, what you want to achieve in life. And usually what you want to achieve in life is things like you want to own a home, income in retirement. Income in retirement is probably the most important there. Others may have a goal of building their own home, educating their children or even themselves, building an emergency fund, or even traveling. So have your goals very clearly defined. Secondly, you, as an individual, again, just like a group, you have to understand your risk tolerance. And again, it follows the same things like what I mentioned in the IPS, the willingness and the ability. And basically, ability, again, like I said, the longer your investment horizon, the higher your ability to take risk. The wealthier you are, the higher your ability to take risk. The other thing, if you don't have an emergency fund as an individual, your ability to take risk is low. So your first priority should be to build an emergency fund, have adequate insurance, then you can begin your investment journey. And the best way to look at it is once you have mapped out your goals, then you attach an investment to each of those goals. So if the goal is very far away, then you attach a long-term investment like property or shares. If your goal is very short-term, you attach a short-term investment. Okay, so you are basically attach an investment to each objective, and that is the rule. Now, let's talk about the risk and return trade-off. Most Kenyans just look at return, and then they jump into projects, they lose money, they wonder what happened. Start looking at investments from a different perspective. First, start with the risk. What is the risk of this investment? Because that notion of the higher the risk, the higher the return, that is wrong. It is higher risk, higher potential return, because the potential for losses are also higher. So you first start with the risk and then the return. Ask yourself, this investment is producing a return of 20, 30%. What is the risk behind it? Okay, but as Kenyans, we tend to look at return first without thinking about the risk. And then you wonder why you lost money. Let's look at the concept of home ownership. Apologies for that spelling typo. Now, suppose you live in Nairobi. Money is not a problem. Where would your dream home be? Guys, type in the chat box. If you're in Nairobi, money is not a problem. Where would your dream home be? Rose, what are guys saying?
Let's wait. Muthaiga. Karen.
Yeah, fantastic. Yes.
Somewhere not too rural and not in the city. Nanyuki.
Okay.
Karen.
Stop thinking like a Kikuyu. Think like a Jaluo.
Runda.
Yes.
Kiseri.
And we are talking about Nairobi.
Muthaiga, somewhere in the farm, a very big farm.
Okay.
Yeah.
Great. Let's stop there.
Lower Kabete.
Okay.
Mm-hmm.
Fantastic.
Yeah.
We said money is not a problem, Sindio. And if we look at Nairobi, just to summarize what some people have said, Loresho, Kitsuru, Karen, Muthaiga, Runda.
Mm.
A typical house in that neighborhood would cost about 100 million Kenya shillings. But remember, you have money, there's no problem. That house, in terms of rent, would be about 350,000. If you gave me 100 million today, I'd go to Kasarani, I buy 50 by 50 plot for 5 million. I build flats upwards, either 4 floors or 5 floors. And I'll spend 5 million plus 20 million, which is 25 million. I'll build corner to corner. Mtu akitaka parking ajipange. Now, since I have 100 million, I can build 4 of them for the 100 million. My income for each would be about 250,000. 4 of them, I get $1 million. Then I go and rent that house in Runda. And I have a balance of 650K every month. When you come home, I tell you, welcome home. I have no attachment to the property. If I get bored of the area, I move. So I'll start with Loresho, then I move to Runda, then I move to Karen. Paka my relatives will now think I'm mad. What's wrong with this guy? Every month I'm telling the wife, where are we going? If he tells me she sells, I tell her, no, let's go somewhere far. Because now you're living in your dream location and you have abundance for enjoyment and for traveling. This mathematics works irrespective of the amount. If you think your dream home is an apartment somewhere in Kidimani or Lavington, which will cost about 15 million, the rent there is about 65,000. Go to Kasarani, buy a plot for 5 million, build 2 floors for that 15 million. You have 1 apartment block, total cost of the project is 15M. You're going to get rent of about 250K, and you'll have a balance remaining. So the key thing to ask yourself is home ownership, whether to own or build your own home. Is it an economic or emotional decision? But that is basically food for thoughts. I think, Rose, now we can take questions as we wind up.
Okay, thank you very much for the detailed talk. We have very many questions that have come in. So yes, we shall start. For those who've joined us late, we shall share the presentation at the end of the day. Mostly it's usually a recorded version, so it will come to you as it is. Yes, let's continue with the questions and keep the questions coming as we continue. The first question is from Viola. What are the risks of investing in money market funds? I believe there are risks in every investment. I don't know, David, you want to take 3 at a time or you want to handle one by one?
Let me handle one by one. When
Okay.
I take too many questions, I can't remember them. And right now I don't even have a pen. So the risk of investing in the money market funds is very low. And that is why the return is very low. Remember, the objective of the money market fund is capital preservation, where you don't lose any money. At the same time, it must keep track of inflation. That is why in terms of the money market funds, most of them invest predominantly in treasury bills and some money in deposits. But treasury bills are the main thing in terms of government paper, because you want that inherent guarantee.
All right. Viola, I hope you have been answered. Also, what is your take on investing in apartments now, given the large market and high apartment prices? Still from Viola.
What do you mean by investing in apartments? To stay or for rental?
I would, okay, I don't know, Viola, you can clarify, but I would think it's for rental.
Now, and I mentioned this earlier, the best use of space is going up. Multi-story dwelling units. Buying a simple apartment, the returns will not be high, especially depending on the area. Because remember, how we calculate whether we are making good returns is basically on rental yield. So rental yield means annual income divided by how much it costs. So you'll find an apartment at 15 million when you can do the same in maybe Kasarani, but your rental income from multi-story dwelling units will be higher than what you'll just get from that one single apartment. So my advice is go for multi-story dwelling units. Hata kama ni unaanza na ground na first floor peke yake, then you move up slowly, furtherly that way.
Okay. I've also seen some, if I can add on to that, I've also seen some groups or Chamas investment groups that take up land as a group and then decide if it's for their own living, they decide to build the houses. So they do a rental apartments, alafu wanagawanisha. Yeah, can also work. Kindly talk about investing in T-bills via mobile. Lately, I've seen the government calling on Kenyans to invest via their mobile phones.
Okay, currently you can't buy T-bills via mobile. They are trying to see if they can do that. The closest they've come is what was called MTIBA. Not MTIBA, sorry. MKIBA. Yeah, MKIBA, where you bought a bond over the phone. The only problem with that investment was, for it to make sense, you needed to put in the maximum amount of money. If you put in the basic 3,000, then your interest was eaten by Safaricom charges, because you paid some charges when you're going in and when you're withdrawing. So the key thing is to understand your expenses, because just like when you're going to buy stuff, let's say from Gikomba or Marikiti, so you'll use fuel. Those become part of your expenses. So whatever return that you get, it must be able to offset the price of the commodity plus also the expenses. And then you see what when I come back to sell, I have already factored in my transport costs.
Okay.
But again, I don't see why anyone should go directly and buy T-bills, because right now T-bills are doing at about 7%, and that is a 1-year T-bill. That means you're stuck there for 1 year. Yet you can go into a money market fund and earn 9 to 10%. That is 3% higher, and you can come out at any time.
Okay. I kind of agree with you there. Money market fund minimums go from as low as 100 shillings for most. I see your minimum initial investment is 5,000 shillings.
Yeah, then after that you can top with 1,000 shillings.
Yes. Yeah, and then you have more like a diversified investment, so you can get more than you can get from an Emakiba bond or T-bill.
Yes.
For Chamas for Kenyan Chamas in the diaspora, what do they need to invest through CIC?
Do you mind answering that question? Anyway, the requirements are basically the same. The only thing usually is like if the Chama is registered, you just need to have the incorporation documents. If you have a KRA pin, the KRA pins of the directors, IDs of the members of the Chama, and a bank statement. The only thing is you must have an account in a Kenyan bank. Yeah. Basically, the requirements are just the same. I don't know, Rose, do you have anything else to add on that?
And also you need just a memorandum, more like a written memo that you have agreed as a Chama to invest.
Basically a resolution.
Yes, a resolution. Yeah. Then we can give you a detailed write-up on the same. If you can leave your email, that is Irene. Asante sana. This is on the next questions. The next two questions are on the example that you had given on land and investment. How can one access credit? I don't know whether you can go back to that slide, David. As you go back to that, the question is, the answer was from Digital KE, Digital LLP. He said, without debt, of course, and then how can one access the credit, this credit? And also from Becky, so it's always better to borrow for investment.
Now, let me answer that in terms of the borrowing aspect. The reason I brought out the borrowing aspect, particularly for land, is because you're buying land where the fundamentals are in place, not in some far-flung area where the returns will come up after 20, 30 years. And to buy land in those areas, you find the prices are generally higher. So you find that you cannot basically afford. So that means you have to go and get debt. But there's good debt and bad debt. If your debt is backed by an asset, then you're okay. If it's for consumer, then there is a problem. Now, the reason about debt now, was because this, like you see, like this piece of land was 4 million. As a Chama, you may not have the 4 million. But you can actually just go and borrow the entire 4 million and make money out of it and pay back the bank. Basically, you're using other people's money to make money. And there's nothing wrong with that. Now, in terms of the stock market, please don't go to borrow to go to the stock market. And the other thing with debt is that always get your financial advisor to do the mathematics for you to know whether you're going to get a higher return than the cost of borrowing. If your return is higher than the cost of borrowing, then it makes sense.
Okay.
Sawa.
Yes. For most of us, I hope you've been answered, Becky. Becky and Digital LLP. Then there's a question from Wandia. For most of us who are risk averse, fear debt, how do I get a loan as a Chama if our capital is not as much? And do money market funds give loans? Let me answer the last question and then you can deal with the first question, David. No, money market funds don't give loans. Unless there is an innovative product that fund managers can come up with. But you can always invest in, if you're not investing in a money market fund, or if you want to get a loan as a Chama, I think you can also invest in a SACCO, push up your savings, because SACCOs give up to 3 times your savings. And you can do the project that you want to do. David, if you can add on to that.
I'll add on to the next, the other question. You can actually use your savings in a money market fund to get a loan from the bank.
Okay. As security.
So you use that investment in money market fund as security to obtain a loan from the bank. But now you will not be able to liquidate those funds because the bank has used them as collateral. What was the first question?
The first question is, how do I get a loan as a Chama if our capital is not as much?
There are quite a number of banks that have products that are tailored towards Chamas. And basically, again, you tend to use your investments to secure loans. Now, the only problem with getting a loan from the bank directly is that, particularly on property, when you're buying land from a motivated seller, remember the motivated seller requires cash as fast as possible, and you're supposed to be there to help him. So as an individual, like my friend did, he went and borrowed from NIC based on his salary, because that loan would come within 3 days. Okay. But if you're using land as security to get another loan, it'll take you about 45 days. So you'll have lost the deal. So you must be able to access credit very fast so that you can help this guy who is in distress as fast as possible. That is the only thing with the loans from the bank. But in terms of getting funding, there are quite a number of banks that do that.
Okay. Does CIC offer free services on investment policy statements for Chamas?
Not really. Typically, what happens in the market is most of the consultants I know charge between 30 to about 50,000 to come up with an investment policy statement. Because it involves quite a bit of work.
Yeah.
But that is one very important must-have document. It is worth the spending.
Yes.
Because again, it also instills discipline in terms of how you're investing. You know, most chamas will close down because of internal wrangling. People are moving in different directions. But when you have defined your objective and then you have a very, very clear investment policy statement, you can't go wrong because you're always following, all of you are following the same document, which you all agreed to.
Okay. I think what I've seen also working for a lot of chamas is they divide the tasks. They have, you do like an investment committee. You divide the number of people that you want to be dealing with the investments. There are some that deal with welfare, some deal with other things, yeah. So the investment committee can be tasked to come up with the investment policy document. You can be guided by a financial advisor on your end. Also come up with a constitution that has the rules for the Chama. That one is the one that guides basically everything that you are doing for that Chama. You can ask a lawyer to draft one, a basic one. You can find them online actually, and just draft them according to your needs of the as a Chama. Yeah. And there's a question from Ezekiel. I hope, Caroline, we have answered you. From Ezekiel Gadure, what are the best investment options during this pandemic period?
Now, when you're thinking about investments, irrespective of the period, you always look at first your tolerance for risk. Even if maybe your ability to take risk is very low. Even if you see a very good opportunity, you don't necessarily have to take it. For example, if your risk tolerance is very low such that you cannot buy shares, shares in the stock market right now have lost about 30%, mainly because of foreigners exiting the market. So there's a very good opportunity in the market right now, let's say in the banking sector, in Safaricom, Chama, because those shares have gone significantly down in price. So that's a very good opportunity for the future. But if you're not able to take risk, don't go and buy those shares, irrespective of the opportunity. Because if things go worse, because we could have another second wave of a second and third wave of infections, both globally and locally, and those shares go further down, you had no tolerance to take risk. Now you need the money, now you're going to sell them at a loss. So again, it all boils down to your ability to take risk.
Okay.
Yeah, and it's not, when somebody says they are risk averse, what is more important? Risk averseness is more like what I was calling the willingness to take risk. It is all a function of your brain. What is more important is your ability to take risk. The wealthier you are, the more risk you can take. The poorer you are, the less risk you can take.
Yeah. Okay. From David, I think this is from the question that you had answered earlier on the risk on investments in money market funds. There's more need for more clarification. Apparently, you've said the risk is just low, but you've not said it specifically.
Okay, I'm not so sure how to answer that question, but basically, money market funds invest in bank deposits, which are very diversified across various banks and treasury bills, and some bit of commercial paper. And the reason we say even treasury bills, we sometimes call them risk free, but like every investment has risk. So that's why, like, because we are investing particularly in government paper, which is basically guaranteed, that is why the risk is low. The risk is not at nil, but there's an inherent partial, what I would call an inherent guarantee, because of where the money has been placed. Yeah.
Okay.
With money market funds, you would go wrong.
Yeah, for sure.
Unless the fund manager is very aggressive.
Yeah. And especially when I think the biggest, if we can just demystify the risks that have been there in the market when it comes to money market funds, we've seen what happened to funds like Jengis, but just because of where the investments had been placed, and also Amana, still also because of where the investment had been placed. However, what the fund manager does basically is try and mitigate the risk, because also where they are placing the investments, the risk is at low. It's almost very low. Yeah, that is bank deposits and government securities. There is a question from Gatimo. What investment options would you advise for a Chama with a net worth of 1 million shillings?
What is the monthly contribution?
Gatimo, kindly, you can tell us that. Then we can continue with another question before that.
Okay. Yeah? Even before you said it was Gatimo. That's a very hard question to ask. Eh?
Yeah.
Because again, we have to sit down with your group, understand your willingness to take risk, understand your ability to take risk, understand the constraints that you have, liquidity, tax, all those issues, to determine, because we need to look at the current situation and the situation where you want to go. Okay. And when we look at the current situation, I'm also looking at what are the age, like the investors, what age group are they in? Are they older? Are they younger? Remember, when you're younger, you have a longer investment horizon, so you can take on more risk. Eh? If you're older, then your risk tolerance goes significantly down. There's a very big Chama that was formed quite a while back. Now they own a building in CBD, but what they did is they did the same strategy that I had mentioned. They would buy land, cut it up, and sell the pieces. So they kept doing that and reinvesting the money. They were quite young, and they knew they would do that for another about 30 years. Now all the members are retired, so their objective has now moved from growth to income, because now they're retired. They need income in the form of rent to substitute the salary that they used to have. So with all that money, they bought a building in CBD. And that Chama is worth about 2 billion. And now they're all older men, 60 and above, enjoying their rent. So again, Gatimo, that's a discussion you can have with Rose, like on the side, now to determine the best investment for your group, because we have to look at the group dynamics first.
Yes. All right, Gatimo, we look forward to hearing from you. We shall reach out as well. Can money market work as a retirement fund stroke planning option?
Yes, it can, but not entirely. And the reason being, in retirement, you're looking for basically income in retirement. So you're looking at a return, let's say, from rentals, which every year will escalate, going upwards, more stable. Money market funds sometimes tend to fluctuate. So when interest rates are, you see, like now in this period, government is trying to reduce interest rates. So interest rates are coming down. But if you had rental property, your rental property is intact. In fact, every year it's supposed to escalate by about 5%. So part of your money will be in money market, but your focus should more be on income generation as opposed to capital preservation.
Okay. Does CIC assist with purchase of property from motivated seller?
Not really. That you have to do on your own, because now if you're looking to buy from the auction, you just need to understand the dynamics of that property and then use lawyers. But we do at CIC Asset Management, we don't. We just deal with the collective investment schemes, in managing collective investment schemes and managing retirement benefit schemes.
Okay. In the case of let me you can answer this one. What is the advantage of investing in money market over SACCOs?
Now, when you're putting in money in a SACCO, you're ideally looking to borrow in the future. That's the way I look at it. In the money markets, you're just looking for a place to park your idle cash. That's the main difference. The only thing that you should be concerned about, especially with the SACCOs, is if you went and borrowed, let's say 300,000 from the bank at 13%, and then you went to the SACCO, and your SACCO says you can borrow 3 times your savings. So you saved 100,000, so you can borrow 3 times that. You're borrowing 300,000 at 12% per annum. The only thing that you must understand, when you're paying that charge of 12% in the SACCO, they're going to charge you 12% on 300,000. Okay, the bank is going to charge you 13% on 300,000. But remember, out of the 300,000, the SACCO is purporting to take as interest. 100,000 becomes yours, or rather 100,000 is yours. So essentially, you have only borrowed 200,000, but paying interest on 300,000. So in the SACCO, sometimes you have to do your mathematics correctly, because effectively your interest rate in the SACCO is actually higher than one in the bank, because you're borrowing your own money. That's what you need to look out for. The only good thing with the SACCO is that when things go wrong, you can always go back and deter. At the bank, it's very unlikely that they will listen to you. So there's that kind of safety or peace of mind in the SACCO that they would come after you when you start defaulting.
That is the question was advantage of investing in money market funds over SACCOs. Yeah.
So there's no advantage over either of each, because each of them has a different objective. One, the objective is to save. To borrow. The other objective is to save. So even money in the SACCO will form part of your investment portfolio, so to speak.
Okay. Let me combine that question with another one. Would you kindly talk about exiting a SACCO in the event that I want to leave my SACCO? What do I need to do? Is it legally possible? Yes, it is legally possible.
That's a tough one to answer. That's a tough one to answer, because I'm not a SACCO expert per se, and I've never exited one. I'm a member of a SACCO, but really I've not even exited one. And I don't even understand how. Sometimes I have arguments with them in terms of how the SACCOs work. Because what they call dividend at the end of the year is actually not dividend, but actually interest on my deposits.
Deposits, yeah.
But I honestly can't answer that question.
Okay. I think I've exited one before. It is legally possible to exit. However, you give them a notice of about 60 working days. Then they transfer the money to another account. You can go collect your money after that. Yeah, but it's 60. For me, it was 60 working days, an exact 60 working days. Yes. That was Chama SACCO. I don't know whether there are any more questions coming in. For the case of Jengis, it's just that they had placed investments in Chase Bank, and when Chase Bank, it's not like the fund went down. The fund is still existing and it has come back very strong. Amana had placed investments in is it Nakumat, the Nakumat CP commercial paper?
Yes, it was. I mean, what they did.
Yes.
I think they put too much money. That was their problem. You see, like now, for example, like at CIC, our commercial paper holdings are like 2% or 1.5% of the entire portfolio, and we have like 3 companies. So even from an investment perspective, as an investment manager, there's something called the prudent investor rule. That you don't put your eggs in too many eggs in one basket. I think that's the blunder they did. So according to their statement, they had put 25% of the investments in Nakumat, which from an investment perspective, I find that is very, in as much as legally you can do that, practically from a prudent investor rule, I can't put a quarter of my money in one investment.
Yeah, it's good to diversify, mitigate the risk. Yes, so that's basically what happened. The funds are still there. I think investors access the funds in bits if they want to withdraw. Jengis has continued with has continuity already. Come back as GenCap. They haven't changed the name really. And they have a very strong money market. Amana, I don't know whether client investors can still access their funds yet because they had been frozen for a while by Capital Markets Authority. But once they do, they can still be able to continue maybe in investment. However, now that's how you know that a money market fund has mitigated risk, because if anything was to happen to this fund, another fund manager can actually come in, buy it off probably for continuity purposes. Yeah, correct me if I'm wrong, David. You're the expert.
Yeah. You see, these collective investment schemes are basically trusts, so they're independent entities. So if anything, let's say, was to happen to CIC Asset Management, the trustee will just appoint another fund manager to take over.
Yes.
Because remember, the money is not in CIC; it is in that trust. Same with even the custodian. In as much as, let's say, CoBank is the custodian, if CoBank was to collapse, remember the investment manager has given the custodian places to where to go and invest the money.
Yeah.
So even the money let's say that was collected yesterday is not in the bank as a deposit. It is what we call a safekeeping account, which is separate from the bank's assets. And since they are separate and the work of the custodian is just to keep records, the trustee will just appoint somebody else to now take over and collect those pieces of paper as records and continue. Yeah. So I would say these collective investment schemes are basically, of course, bulletproof. Now, just depending on your risk tolerance and where you're headed to go. Now you can now choose the different kind of the different kinds of funds to invest in.
Okay. There's two last questions. One is from Facebook. I will read it out after. What are the effects of COVID on Chama investments? And is it prudent to wait or invest now?
Again, a tough question to answer, because again, it boils down to what I had said earlier about your risk tolerance. If your risk tolerance is high for a Chama, you can also do shares. There are people right now who are desperate, who are selling land at very good prices. So, like Warren Buffett says, sometimes you take advantage of a bad scenario to make money. Because, like Warren Buffett, he may invest when times are very bad, because that's when you get the best prices and the best discounts.
You still there? We are forming a Chama. There's a discussion of what legal entity can we form to hold our assets.
The most common one is just a limited liability company. It's the easiest to administer, and nowadays it's very easy to form one on eCitizen.
That is,
and the other thing also, you don't have to go to a lawyer nowadays. For him to write the memorandum and articles of association, what the government has done is that they've simplified the process by having you just adopt the model. What do you call it? The model memorandum and articles of association.
Yes.
It just costs you about 10,000, I think 800.
Yeah, for registration. I think we can have that discussion more, Ken. Is it a wise investment to convert an income booster insurance policy to MMF? That is to you, David, definitely.
Okay. Now, insurance is very important. Okay, but my opinion is that insurance should be very separate from investments because they both have very different objectives. Because insurance is about protection, investment is about return. Okay. So would have to first understand that insurance policy that you have. I'm assuming it's a life policy. Would have to have a look at it, understand what advantages and disadvantages that it has, and then compare that with the money market. So we can take that. We can take that offline because I have to go. We have to go through the document.
Okay. All right. I think we have more questions coming in. For Evelyn, during this pandemic period, which investment plan is wise, long-term or short-term? I think it's a combination of the two. You need to have a short-term investments for an investment plan for maybe emergency savings. And also, you need to have a long-term investment because you don't know what will happen in the next few years to come. David, any word on that?
Very true, but again, some of these discussions can be taken offline because again, you have to understand the risk tolerance of either a group or an individual to be able to advise on what investments to make. And basically, that's why we are here. Once the webinar is over, then maybe after that you can get in touch with us, and then we can expound further because each person's scenario is very different. It's not you cannot give the same advice to everybody as in blanket.
I agree. I've sent the email address for further questions. That is info@vasiliafrica.com. Kindly reach out to us. Irene, we shall take it offline as well. There is one question that was sent on Facebook. If you can answer it, what would you recommend buying using a broker who determines which shares to buy, or buying through a broker but you decide which shares to buy? But we shall be handling stock investing in stocks next week on Saturday, same time, but you can answer as we wait.
Okay, my advice is this: in case you don't know too much about the stock market, go and talk to the investment analysts. Those guys will give you unbiased advice based on research that they have undertaken. Okay, but ultimately, you are the one who has to make the decision, because once you've been given the advice, it's up to you to go and fill in the forms or send an email to the stockbroker on what shares you want to buy. Avoid talking to the guys at the front desk and avoid talking to the traders. talk to the investment analyst. Theirs is unbiased.
Okay. Asante sana. I think for more questions, we can shoot them on the email that is info@vasiliafrica.com. The ones directed to David, we shall send him directly and he can answer them. David, if you can share your contacts as well.
Actually, the next is actually yours.
Yeah. Oh, it's mine, but, yeah? Oh, it's fine.
Yeah, it's yours.
All right. Asante sana. But we can, you can share you can read out your number as I type on the chat.
0720 993 418.
418. Yeah. That is for David. Asanteni sana, and thank you for joining us today. It's been a very engaging conversation. Barbara, asante sana for assisting with answering some of the questions. We look forward to engaging further with you. And yes. All right, Evelyn, yes, we shall be sending out the info. Asanteni sana. Same time next week on Saturday, we shall be handling investing in stocks from a stockbroker perspective. Thank you so much for joining us today. And David, asante, and thank you for being on call when we reach out.
Sasa, thanks for having me. It's been a great session.
Yes.
Have a lovely weekend.
Asanteni. Now you can go to your Chamas and discuss how to invest. Thank you.